The Bank of England has stood pat on monetary policy this year even as investors call for more rate increases, with inflation exceeding the central bank's 2% target. But Carl Weinberg, chief economist at High Frequency Economics, says the central bank's decision to hold back on rate increases so far this year may be the prudent choice. He observed, in a recent note, that while the central bank has only delivered 1/4 percentage point rate increase since November, the real yield on 10-year UK government bonds, known as gilts, has risen more than 4 times as much, suggesting Britain is already grappling with tighter financial conditions. Given a real rate increase that large, even a stealthy one, who can be surprised that GDP has slowed, consumer spending and investment are sagging, and bank credit growth is dropping toward naught, Weinberg said. Some say the real yield is the main transmission mechanism for a central bank's monetary policy, and not so much the nominal yield of a government bond. It reflects the difference between a bond's advertised yield and inflation expectations over the maturity of the bond. High-frequency economics UK inflation is trending lower. UK real yields have shown a sharp climb because of falling bond prices and moderating inflation. The yield on the 10-year gilt TMBM KGB10Y 0.00% was at 1.47% on Monday, versus 1.26% on November 3, according to TradeWeb data. Weinberg expects consumer price inflation to slow to a 2.1% pace in May, after it moderated to 2.5% in March from 3.1% in November. Bond prices fall when yields rise. Using May's inflation estimate as a proxy for price expectations over the next decade, Weinberg calculates the 10-year real yield has climbed around 120 basis points since the BOE's 25 basis point rate increase in November. This climb in borrowing costs flies in the face of investors who feel the UK central bank should do more to tighten credit. While Citi analysts have been obsessed with predicting the timing of the first rate increase by the MPC, the Bank of England has been stealthily tightening monetary conditions for half a year at least, said Weinberg. Over the past year, the BO has been reluctant to hike rates over concerns it could throttle an economy already dealing with anemic growth, even as critics say an above-target inflation rate hurts the central bank's credibility. Acknowledging those concerns, some senior officials within the BO have indicated further rate increases should be in the cards this year. Gert Jan-Vlieg, member of the BOE's Monetary Policy Committee, said he expected 1 to 2 rates hikes every year over a 3-year period. But with real interest rates rising faster than the economy's trajectory, the central bank may also have reason to continue sitting on its hands. Higher inflation-adjusted borrowing costs can crimp growth and chew into the bottom line of British firms. Britain's economy grew 0.1% in the first quarter, an annualized rate of 0.4% and its slowest pace since the fourth quarter of 2012. Much of that decline came after construction contracted by 2.7% quarter-over-quarter in March, while business investment grew by a tepid 0.3% for the fourth quarter of 2017, according to the Office of National Statistics.